Hey, welcome everybody. Martinis with Scott on a Monday night of a long weekend. Coming to you from Fernie, British Columbia, beautiful British Columbia, as they say. I'm in the basement of this country home that I'm renovating, so hence the Irish pub look feel to it. We'll be getting there. I've been shooting videos here all week, and people have been asking me about the location. Today we're going to jump right into it. We may have maybe a long show. We'll see how this goes. We're going to talk about turnaround predictions in the cannabis sector. Last week was a huge week for news. I couldn't keep up with it, but I did pick four events for us to talk about. One with Aurora Cannabis, Invictus MD, CannTrust Holdings, and Acreage Holdings, I think they are, or Acreage Cannabis. I'll get to their proper name. Anyways, so four stories from last week. And the goal of this show is maybe I can provide some interesting perspective for you on these events and these companies. And I'm going to use it as an opportunity to talk about the idea that there needs to be, in any turnaround, in any transition that a company is going through, there needs to be a strong turnaround leader. And as an owner, a stakeholder, investor, anybody who's involved in a turnaround situation, one way to evaluate the possible success of that turnaround plan is to see whether there's a true turnaround leader, whether that be a CRO or any other executive who has turnaround management skills. And without that, there's a pretty good chance that this turnaround's not going to succeed. And with that in mind, I'm going to have some fun today. I'm going to make some predictions about the possible success of these turnarounds. And how do you define success in a turnaround situation? At Sinclair Range, my company, we define it as saving jobs. It's not necessarily all the jobs, but you save as many as you can. I think for the purposes of this, I'm just going to say, would I invest in this company, in these four companies, based on what I know about them today? And that's what I do for a living. I invest in companies that are high growth or in a turnaround. We try to help them. And so I have some expertise in knowing whether I should be investing in these things or not. So maybe that would be fun and interesting, and we'll see what we could do. By the way, we don't give investment advice. I don't give investment advice, not qualified to do so. Don't trade based on this. This is my thinking. I bring a lot of expertise in a bunch of different areas, but it's up to you to decide what you're going to do for trading. I'm not selling anything. I'm not even trading these necessarily, although I do trade CannTrust. Just keep that in mind. I'm not giving you trading advice. And, what's interesting about, you could talk about turnaround in the big picture. Maybe it's going to succeed, maybe it's not going to succeed. And that may have nothing to do with what the stock does in the short term, right? So the stock may pop or may go down, which would just be a market overreaction. So it's there's a lot of reasons not to trade on this advice, but maybe you'll learn something, and maybe we can learn something together. And you can take it into consideration when you're looking at your own troubled situations, your own businesses in transition, if you're a manager or a board of directors or investing. So let's jump into it. With that, the first company we're going to talk about is Invictus MD Strategies. Invictus MD Strategies. Like, I knew nothing about this company before last week, but we've done on the Martinis with Scott channel a bunch of shows about insolvency and using the bankruptcy courts to help with the restructuring in the cannabis industry, both in the US and in Canada. And Invictus is really interesting because they've filed, and the court has accepted them in a CCAA. We'll get to that in a minute, but a CCAA, which is a formal court restructuring in Canada. And I believe they're the first cannabis company with a license to do that. You can fact check me on this. I'm not 100% sure, but I believe they're the first. We have had companies go into restructuring. We had one company go into restructuring that wanted to have a license. They were in the application process, but they didn't actually have it. We had one company that had a license, lost it. It was rescinded by Health Canada, and then they went into a restructuring insolvency process. I believe this to be the first that actually has licenses and gone into a restructuring process, which is why I found it interesting. They're traded on the Toronto Venture Exchange on the symbol GENE, GENE, also traded in Frankfurt. Between 2014 and 2019, they raised $125 million, which is probably light for a cannabis company in Canada. They bill themselves as primarily being an acquirer and investor in the cannabis sector. A couple of key holdings would be Acreage Pharma, which is an LP, a licensed producer and licensed seller in Canada, dried flowers and oil extraction. Leafwise, under a numbered Alberta Corp, which has medical clinics in Alberta. AB Laboratories, which is another licensed producer, LP, and seller in Canada. February 13th last week, they were granted an order for CCAA, I think in BC. Now, if you're not Canadian, if you're American, Chapter 11 is similar to a CCAA. Company Creditors Arrangement Act is the Canadian legislation. Similar to a Chapter 11, debtor stays in position, so existing management board stay in position. There's no receiver or trustee that takes over anything. And the restructuring is intended to go to the court and ask for their help to facilitate a restructuring to preserve shareholder value, is the bottom line, or stakeholder value. So why was this company, Invictus, in trouble? What was going on? Most recent quarterly financial statements from October 2019, they had $12 million in current assets, but $3 million of that was inventory, which they later tell you isn't selling very well, and when it is selling, it's selling at a loss. And 5.5 of that receivable was from associated companies. So by my estimation, there was about $2 million of liquid assets as at October 31, 2019, yet they had $12 billion in current liabilities, $10 million of which is accounts payable. So very underwater from a working capital perspective. Revenue for the 3 months was $800,000, which was actually less than their production costs. So their their production costs was more than their revenue. Same for the 9 months ended October 31, 3.4 million of revenue, which was also less than their production costs for the entire period. Had a net loss of 8 million for the quarter and 20 million for the year. I believe that was trailing 12 months. Revenue that was down 20% quarter over quarter. And it said because their product was undesirable. We'll get to that in a second. And a general oversupply in the industry. They had a bunch of cost overruns on a new phase 3 build out of a greenhouse, I assume. So that's the backdrop from the latest financial statements, October 2019. December 16, 2019, they announced they signed a binding letter of intent with Unified Cannabis Corp of Calgary for a private placement to bring in $5.7 million in cash. This replaced a prior deal for $6 million that fell apart on them. And then January 3, they announced that this deal also fell apart. They did not get the 5.7 in cash. And their press release cheekily says that they claimed that Unified did not have sufficient funds to close the transaction. Announced January 3, 2 business days after the release of the October financial statements, public release of the October financial statements, 2 days after. And they blame the lender for not having cash. Do you think the lender didn't have cash, or do you think maybe they were spooked by those crappy financial statements? What else? Unable to pay salaries as a result. So at Acreage Farms, which is their primary LP, so they haven't made payroll since December 28, 2019. They have 7 security cleared personnel who have all said they're going to leave if they don't get paid soon. And without the security licensed personnel, Health Canada they will just pull the licenses, and then the game is more or less over. I already mentioned the over roughly 10 million in AP. Much of that is 150 days old, so they haven't been paying people. It's pretty late. Their bank, ATB, which is an Alberta-based bank, maybe Alberta Treasuries branches, something along those lines. They owe them $10 million, and they have security over most of the assets of the company. They missed an interest payment to ATB of 180 grand on January 31. And so ATB demanded and served their notice of intention to enforce security, which is the first step every lender has to do if they want to go take over the assets, which is an odd step for ATB to have taken, because if a receiver steps in, there's a good chance they're just going to lose a strong chance they're going to lose these licenses with Health Canada, and there will be no business. So I think for ATB, I don't have any background on this, but for them to have demanded and served their NOI, their notice of intention to enforce. Just means there was a complete breakdown in trust and faith in management of Invictus, the borrower. They disclosed in a filing related to the CCAA that their genetics, their strains, are not in demand because they have insufficient potency. Therefore, their operations, even the greenhouses that are operating, are losing money. So, side note, the black market is still in Canada 5 times larger than the legal market. Why? Because it's easier to buy black market, it's cheaper, and the genetics, the strains are way, way better, more potent. I'm not a smoker, so I don't really know, but if you go in and talk to people that are dispensing, that own stores, that's the message you're going to get, and that's what the market's seeing, and that's the reason the black market's still 5 times larger. And so this Invictus has just admitted here in their filings that their genetics are crap. Nobody wants to smoke their flower. And so they're trying to get they are getting new plants, new genetics and strains to grow, but nowhere did they tell you what they're paying for that. Normally there would be a fee or a royalty agreement. If you're in CCAA, I don't see how you pull that off and make that sort of change. So there's an unexplained issue that puts a black mark, I think, around this restructuring and turnaround plan. Indebted to a New York City, this is the one that makes me the most sick. Indebted to a New York City marketing firm, ABG HMX, for $4 billion US, 5.3 million CAD. This is a company that did 800,000 in revenue in its last reported quarter, and they've got marketing bills of $4 million US, which it doesn't give any detail, but I bet you, for those on the podcast, I am doing air quotes. I bet you that's just to build brand, whatever the hell that means. Okay, so the CCAA filing goal is to immediately find liquidity. Excuse me. Try to still on my vodka here. Preserve cultivation, sales, and oil extraction licenses, and restructure. Because they couldn't get more financing, they couldn't get a bridge loan, they can't sell the licenses, they can't bring in a bunch of equity because of change of control. So the only option that they seem to have, which is probably true, is to restructure in a CCAA, get some debtor in possession financing, and see if they can work their way out of this trouble and ultimately bring in a strategic partner through a sale process. I think that would be the idea. So I'm here to predict, walk through some of these issues. Will this restructuring succeed? Would I invest? Well, from the MD&A, the Management Discussion and Analysis filed for the October 31, 2019 financial statement, I counted 12 instances of material management changes and board of director changes from the beginning of 2019 to October 2019. So 12 material changes in this small little company, some of them involving multiple people. So there's chaos up the top, lots of turnover. The CEO resigned as part of this CCAA filing, so now they have no CEO. I think the executive chairman stepped in as an interim. They don't have a CRO, a chief restructuring officer. They have not appointed a turnaround leader. And here's a quote for you. They have no fixed location from which the company has no fixed location from which its corporate governance, managerial, or financial functions are conducted. In other words, they work from home, all of them, spread throughout the country of Canada. And, Sinclair Range, my company, we're very virtual. We're the same, but we do have a head office. We do have people show up there every day. All the books and records go there. So there is centralized governance. And the bottom line is we do really well. We make money and we're a successful company. We can afford to be virtual and everything that brings with it. But if you're a troubled company, you need to hunker down, change culture, and start making profit, this is death. This is impossible to manage this. So that was a big black mark in my eyes. And in none of the filings or press releases have there been, other than the genetics, there's been no serious or any discussion of operational changes. There's no talk about changing the business model, reducing costs, budgeting, cash flow management. Very little or any material talk about that. They don't have a turnaround leader. They have limited resources. They have limited value. This is not going to succeed. I wouldn't invest that, which is not advice to you, but I wouldn't invest. That's my judgment based on what we know on Invictus. So I thought that was interesting for last week. Let's move to the second one, CannTrust Holdings. Everybody knows a favorite of the show. I did a quick shot on CannTrust last week about their not filing their financial statements. We did a couple of shows, maybe even 3 shows in July, August 2019, and one subsequent to that. I think one of those shows was called CannTrust Shows Us What Not to Do in a Turnaround. It's been an unmitigated disaster in my view. Well, and everything has shown that. You can go back and look at those shows to sort of get the background on what's going on with CannTrust. So I'm not going to repeat it for everybody here. I had a question from my quick shot last week on CannTrust. We had a question from a viewer, Mr. Dan C. Give a shout out to him. Thank you for watching and participating with a good question. And the essence of his question was, are they going to get their Health Canada license back? Are they putting in a best effort to do that? And do you think they'll win at it? And my answer is yes. I think they will get it back. Health Canada has already played their cards on this. They've shown what needs to be done. The trick is going to be confidence in management. Do they believe that the illegal grow, the fraud from the past is over and things have changed within the company? I don't know that CannTrust has convinced Health Canada of that. They haven't convinced me because a lot of the players are exactly the same. But that's one step that would have to happen. They'd have to file the remediation plan, and they have done that. We'll get to that in a second, or at least for their main growing facility, they have done that. It's funny, I don't understand why that's such a big deal, since the remediation plan would be very similar, in fact, no different from the original plan that they would have filed to get the license to begin with, right? I mean, there's just a process for this. Everybody knows what it is. There's a bunch of consultants that can help you. It could have been done in a very short period of time. In any event, remediation plan is filed for one of them, and you need some money. You have to pay counsel and consultants, and you have to survive in the meantime. And CannTrust have had lots of fun. So I just think there's a road path that Health Canada has laid out. I think they've got enough money to try and get it right. And so my bet is they get their licenses at some point, not necessarily quickly, but at some point. So that was last week's show. It was my answer to Mr. Dan C. Now, February 13th, last week, subsequent to the quick shot, CannTrust comes out with another announcement, and it says a couple of things. One, it says that it submitted on February 14th, so last Friday, documentation to Health Canada regarding the completion of the remediation activities at its Niagara facility, which is their primary grow facility. The filing was made to get the licenses reinstated. So again, I have a question about why that took so long. I would have thought that could have been done last June, but anyways, that's done now. The second point is that they're doing the same thing in Q2 2020 for their facility in the north part of Toronto. I think it is in Vaughan, right? Yeah, in the Vaughan facility. And I think in CannTrust that facility is an oil extraction. I'm not 100% sure about that, but in any event, whatever that facility is, they haven't submitted that plan yet, but they intend to. Third point was that once those are done, those 2 remediation plan submissions, there's no assurance that Health Canada is going to do anything about it, which has been certainly they've been slow on these sorts of things. So who knows? And that the board of directors and its special committee is now going to go back to the potential strategic alternatives and view what needs to be done now that they've applied for these licenses to have them reinstated, which is a bizarre statement. I mean, this has been going on since July, August 2019. They should already have a plan, and they should have told shareholders what that plan is. And this is the entire problem with CannTrust, is it's never been full disclosure. It's never been a blunt admission of all of their difficulties and a strong, quick laying out of a plan. But now the release gets more interesting, because what they tell you is that they've appointed a new CEO whose name is Greg Guyat, I don't know how to pronounce it. and he's the company's new CEO. He was formerly the CFO. Now, that's an interesting move. Is this positive? Is it negative? Well, it clearly means they couldn't find somebody from outside the company, but that's not really a surprise in this market. There's lots of companies like Aurora that are searching for a CEO, and it's hard to find people in this industry that are qualified and want to step into the current market conditions. In my view, it's a great positive that they got rid of the last interim CEO, because I don't think he was doing a very good turnaround job at all. In fact, I've got several hours of recordings, videos saying exactly that. However, he's still on the board of directors. He's still calling the shots from behind the scenes, or maybe from in front. I think he's executive chairman. So he's still the guy. So they haven't really got rid of him. He was there when the issues went down. So if I'm a shareholder investor, I'm not happy about that. And then my question is this new fellow, Greg, the new CEO, is he a turnaround leader? Because this show, the theme here is to talk about needing a turnaround leader to be able to effect a turnaround. So the release goes on. The company reminds readers that CannTrust remains in default of its disclosure obligations under securities legislation. This is the last quick shot we did about financial statements. It has no material revenue because their license was pulled and they can't sell anything. Has terminated and laid off most or a significant portion of its workforce, has no employees left, is facing a variety of regulatory investigations. That's both Health Canada and security investigations. Go to prior shows to learn about that. It has significant contingent liabilities in Canada and the US. This would be all the class action suits, the security suits. Says here, potential civil damages, potential criminal, quasi-criminal, or administrative penalties and fines. So there could be some big numbers racked up from all of that stuff. So that's a pretty blunt disclosure, all of it true, which we've never seen from CannTrust before. It goes on to say the nature and timing and the outcome of the special committee's work will be influenced, amongst other things, by CannTrust's ability to extend or renew its insurance coverage. Here they're referring to their director and officer insurance because, of course, the directors and officers had the illegal grow. I'm sure the insurance companies are being sued, so they're probably not very keen to reinsure, for the most part, the same people. Whether Health Canada reinstates the licenses, how long it will take to restore operations if they are relicensed, and the expectation of resolution of all the lawsuits, including the class action suits. So again, super blunt admission, I think, of all the material trouble which we have never seen out of CannTrust before. My bet is that this Greg, the new CEO, however you pronounce his last name, my bet is he's the driver of this different tone and full disclosure and honest disclosure, and I like it. It gives me hope, because the first step to fixing these problems is to be able to admit them, not try and hide behind them, not try and blame somebody else like they did. If you go back to the earlier shows, you're going to see that their initial reaction was that this was a training issue. You know, people hung up and constructed a false wall to grow illegal plants behind to trick regulators because they were poorly trained, right? We seem to be past that, and we've got no excuses. We got full disclosure, and I think that's a good thing. The company, as of January 31, has approximately $167 million in cash still. Sounds like a lot. I remember back in the 90s, Hollinger, someone will correct me on this, but I believe it was burning through $10 million a month in board and director and professional fees. This money just goes quick, particularly with the class action suits outstanding, but still sitting here today, $167 million. Will this turnaround succeed? I have several shows saying they're doomed. I'm a little bit more bullish with this change. They still have some money. They have a new CEO. I like the first release. Obviously need a lot more information. Remember that getting a license, everybody thinks that getting a license is going to be the home run for, well, we're back in business. You're not back in business. You're out of staff. You don't have any people. You don't have any people. You don't have any revenue. You've got a horrible reputation in the market. The industry is saturated. You can't. So, everybody else is cutting back. What are you going to do? Start building up your greenhouses and cultivation again? There's all sorts of issues with restarting this thing. Now, you might get a stock pop. because of a license coming on board, if in fact that happens. But this company's got a lot of trouble in front of it beyond the licenses at this point. But they have cash, and would I invest, which is what this comes down to? The answer is no. I think it's really risky at this point. But I've been short. I've owned puts on this thing, well, since the stock was around $3.50, and we've done very, very well on this through to today. But my original plan was to ride this to zero, and I'm reconsidering that at this point. So I'm going to keep my eye on CannTrust closely. I think there's a glimmer of hope. By the way, could this company be turned around with the right people and the right plan? You bet. Here's what I would do if I wanted to rebuild shareholder value at CannTrust. And again, I have no inside information, but when you're turning a company around, you just need to have a plan and you need to execute, and then every day you need to adjust your plan for what's working and what's not working. What you can't do is sit around with a special committee for 6 months and have no idea what's happening. Here's what I would do. I'd look ASAP, depending on legal advice and solvency advice. I'd be looking to seek protection or some sort of formal way to negotiate and settle or protect the assets from all of these liabilities, lawsuits, contingent liabilities. That might be today, it might be 6 months from now, but I'd want a plan to blow those things out and restructure them as quickly as I could. Audited financial statements, I'd fire KPMG today. I'd go find a smaller auditor, somebody without any baggage on this thing. I'd overpay for a clean audit. And I don't care what the past audit says. I'm not trying to preserve everything. Just clean out the balance sheet, get it over with. Nobody cares anymore. Everybody wants to move forward. Write off all of that stuff. Take huge accruals. And I'm going to change my board, and I'm going to change management. I might even bring a third-party compliance internal control person in, so that the new auditor has comfort that things are going on that need to be going on to support an audit. And I would just pay, because you have the money and you have to have the financials. I would start growing once I have my licenses, but in very limited quantity, because there's no circumstance where where you're going to be profitable just growing a bunch of plants and becoming an LP again. That's not going to work. And I would go out and buy 2 or 3 or a handful of promising but financially struggling, because there's very little capital in the sector right now, small public or private companies that are focused on branding, distribution in cannabis or hemp, because that's where the market's going. I've got a shell, I've got cash, I can grow, I have extraction capability, but there's not going to be margin in that. So what I want to do is I want to use my limited resources to provide that to the companies that need it and bring them in-house to create value for my shareholders. And I would rebrand the whole damn thing. Get rid of CannTrust. I don't know why they didn't drop that name long ago. It's because they have no turnaround plan. That's why they didn't do it. But that's what I would do off the top of my head, and I think is doable. And let's hope that CannTrust gets its act together. Okay, Aurora Cannabis. Most people in space, well, everybody in space knows Aurora. Even those outside the space have an idea of who Aurora is. They're one of the larger Canadian LPs, and therefore one of the world's largest Canadian LPs. They're another struggling company. I don't think anyone's called them a turnaround. I might be the first, but this is a troubled company, a seriously troubled company in desperate need of a turnaround. And excuse me 1 second, I'm just turning Siri off here, who's trying to talk to me as I talk about Aurora. This company is a company that had a market cap in 2019 of $12 billion at one point. Is down to $2 billion more or less now. Dropped in about 9 months, $10 billion of market cap. And everybody looks at it and says, well, that's the industry. The industry's dropping. Nobody's looking at this company in particular and saying, wow, these guys are screwing up. This is a very troubled company. There was a February 7th release, so prior to last week, where they talk about the CEO, Terry Booth, resigned. And there was a search for a new CEO. They're cutting back on costs. They laid off 500 people, which is 15% of their employees. They amended their credit facility So they got rid of their EBITDA and fixed charge covenants. Why do you think you get rid of an EBITDA or fixed charge covenant? It's because you're not going to meet it, because you're going to have negative EBITDA. So you agreed to the covenant when you did the loan, which I think was as recently as a year ago, the last addition to that facility. You agreed to the covenants. Now you're not going to make it. By the way, a fixed charge covenant means that you have enough cash flow to pay your interest and debt service. They're getting rid of that. They put in new covenants, which says that they're going to have positive EBITDA, amongst other things, positive EBITDA by fiscal year 2021, so next year. And they reduced the amount of the credit facility, was taken away from them. These are not positive trends with this credit facility, which is, I believe, led by Bank of Montreal, although it's a syndicate. So there was an earnings call Thursday, I think it was, and I listened in on the call, and here's some of the highlights from the Aurora earnings call. Current state of the market is challenging. Well, we all know that. There's retail constraints. There's evolving markets, they say. I thought this was interesting. They say what they call the value market, and I forget how they define that. The value market, I think, was $8 a gram and under, versus the premium market, which would be higher than that. Don't hold me to the $8, it might have been $9, something around that range. But however they define value, in the summer of 2019 was 2% of the market, and at December 31 was 17% of the market. So the whole market, legal market, is looking for a cheaper product. Premium went from mid-30s in the summer to 17% in December, and Aurora is selling to the premium market. Now, they failed to mention that they're selling crap to the premium market. Different issue, and I'll talk about that in a second. So there's an evolving market that they're trying to keep up with. Distribution inventory adjustments. What does that mean? It means no one's carrying their inventory. The stores aren't carrying their inventory anymore. They used to carry a little bit of inventory. Now they're not. Why? Because people aren't buying Aurora. That's why. So why would I carry a bunch of inventory? So I was in Calgary maybe a month ago, and I was somewhere, and the store beside where I was a pretty slick looking retailer for cannabis products. So I'm not a buyer. I don't use the product. Well, I take some CBD oil sometimes, but I went in to take a look around, and I got talking to the manager there, who was a super nice guy, and he gave me a half-an-hour lecture on what the products were, what sells, what doesn't sell, and unsolicited, he went on a rant about Aurora dried flower in particular, and how it's horrible. The entire community knows it's horrible. It's a terrible reputation. It's a terrible product, and they believe it's mostly a packaging issue as opposed to a growing issue. And he opened up one for me, and he opened up another product which I won't name, but he thought it was amazing, a BC grower, and it was amazing. Like, the freshness difference was huge between the two of them. So it's interesting. The reputation this company has is pretty bad, and it's showing up in the results now. Here was the big one. SG&A was up for the quarter to $100 million from $80 million the quarter before. Why? More people, bonuses, rollout of the 2.0 products, and which is the edibles, and marketing campaigns. And now they're making cuts. So what's their target? To have this positive EBITDA to show the Bank of Montreal. They want to cut down to 40 million to 45 million in overhead from 100 million. All right, that's a 60% cut. That's insane. And this is all because when they amended the credit agreement, well, because they want positive EBITDA, and they have to have positive EBITDA, or they're going to be in default with their lender. So one of the analysts asked a very credible question, which was that they doubt the EBITDA margin, that the EBITDA is going to be positive and the margin is going to be fixed, because your gross margins are dropping off the face of the earth, because your prices are dropping, because that's where the market's going, and no one wants your product anyways. They didn't have an answer for that. Another analyst asked or pointed out that they produced in that quarter 50,000 kilograms more than they sold. So they keep growing because it's a fixed cost business, more or less. So they keep growing, but they can't supply the product. The 50,000 kilograms more than they sold. Do you think anybody needs those CannTrust plants? No, right? So do they expect that to continue? Or the question from the analyst was when will you shutter capacity? Pretty dead on question. and there was not an answer for that either. And they're still looking for a full-time CEO, and they're having a tough time with that in this environment. People are not calling Aurora a turnaround. It's a troubled company. They're not calling it a troubled company. It is a troubled company. I think I might be the first to say it. Their trailing 12-month December 2019 revenue was $290 million, and they had a $220 million EBITDA loss on $290 million in revenue. Will the turnaround work? Will this company survive? I predict not. There is no turnaround leader, no CEO with turnaround experience at this time. They're on a short leash. They've got bad product. Would I invest? Not a chance. Not a chance in Aurora. All right, Acreage Holdings, which I believe to be our last one. I think it is. Perfect. So one way to assess risk in an industry or company is to look at their cost of capital. And in cannabis, if you've been reading stories, cost of capital has been going up all summer. 3 years ago, you hung up your shingle and called yourself a wannabe LP with some square footage, you were going to get $50 million, $100 million. Now it's hard to borrow money, and you can't get equity. And when you try to borrow it, it's expensive, right? So who's Acreage? Well, they're one of the largest vertically integrated multi-state operators of cannabis assets in the United States. They trade on the Canadian Stock Exchange with a measly $500 million market cap, but the stock had been 6 times more than it is today as recently as a year ago. So they had a pretty significant market cap not so long ago. June 2019, they made a deal with Canopy Growth, whereby Canopy has an option to acquire all of the shares of Acreage. And in fact, there's a triggering event. For example, when the US makes legal cannabis, then Canopy is obliged to go through with this. So it's an effective sale to Canopy without actually having a change of control. Seems to be the point of it. The idea is that Acreage becomes a wholly owned subsidiary of Canopy, and that's already locked in. Canopy Growth, who are they? Anybody in the industry knows that. They're the largest producer in the world. They have a $10 billion market cap, 35% owned by Constellation Brands, which is even bigger. They own Corona Beers and other brands. As of today, they have a $39 billion market cap. So Acreage has some pretty significant parents and investors. So February 7th, there's a release, which I didn't understand at first. It took me some time to think through it and read and understand, because I wasn't sure that I cared, and then it just kept bugging at me. So they announced they had a $100 million credit facility. They were running low on money, so they got a new facility for $100 million. Well, that's good news. From an institutional investor, good news. First draw, $49 million in February 2020, great news. Check this out. Interest rate, 2.55% for the first advance, 1.25% on the second tranche, whenever that may be, and the rest to be negotiated afterwards, which is kind of weird. I'm not really sure why you would negotiate interest afterwards. That maybe was the first thing that tweaked me to this being weird. And the fact that it was 2.55%, I mean, it just doesn't make any sense. That's a really low cost of funds for anybody for a $100 million loan anyways. And in cannabis, I didn't think you could get that right now. So it sounds pretty good. Everything good so far. And in the press release, indeed says everything's good. It has the benefits of the transaction. We get our capital needs, satisfies the near-term capital requirements of Acreage and its subs, and creates a path for further borrowings up to $100 million. Non-dilutive to Canopy. The consideration per share to be received by Acreage shareholders upon completion, yada yada, is not impacted by the financing transactions. Financial position, that gives you a bunch more money, and it's not dilutive. So it tells you all the benefits of this. So this is good. This is not a troubled company. This is not a turnaround. So then we read further. It says the first tranche, which as you recall is $49 million, which they're going to get in February 2020, it needs to be secured by cash. $50 million of cash. They need $50 million of cash as security to borrow $49 million. So you can't spend the 50 as well. So now that you have 99, you got to have 50, set it over here as security, and we'll give you $49 million and charge you interest. That seems crazy, right? So the company has negotiated a private 366 days, so a year-long loan of the $50 million that they need as security to get the tranche one $49 million. The borrower for the private loan is a subsidiary of Acreage, but they don't tell you which one. Interest on the loan will be payable in subordinated voting shares, and the cost of debt, if you look through some analyst reports, which I did today, I didn't calculate it myself, but they've estimated that cost of this debt to be 20.3%. So you're paying 20.3% interest to borrow 50 million. So you put the 50 million aside to borrow 49 million at 2.55%. You following this? Interest is paid in shares, and the shares that the lender receives are liquid, and to guarantee that they're liquid, there's a put option back to the company. Bottom line is, depending where market prices go, this could be a hell of a lot more than 20% interest for this loan to get the security. The $50 million private loan is got all sorts of security around it, including the intellectual property and other things of Acreage, so it's a secured loan. And so that all seems pretty crazy. And then here's the kicker. The $50 million private loan at the 20.3, that's what I said, they calculated 20.3% interest. 21 million of the 50 million is coming from Kevin Murphy, who is the CEO of Acreage. It's related party by the CEO is doing half of that. So, and that's just for the first tranche. If you want to get the second and third tranche to go from 49 million to 100 million, you have to keep adding up, putting more cash collateral in to be able to get that. So at no time, who's ever giving you the loan of the 49 plus the two other tranches, at no time is there any risk to them, because they've always got the same amount plus $1 million extra in cash segregated, offsetting that. So to summarize, Acreage, a subsidiary of the largest cannabis company in the world, needed money, and they borrowed it at 2.5% at the parent level, and they secured it with 20.3% money minimum at the subsidiary level, and half of that was done by their own CEO. Why? Two reasons, possible reasons. Either they couldn't get money anywhere else, or it's a cash grab by the related parties, by the CEO, or both. And my bet is, because there's a board of directors and some sophisticated people involved, that is not a cash grab, just that they couldn't get money any other way. And no matter what the answer is, a 25% cost of capital, which is more or less what this is going to be after fees minimum, that's really high. It's a high cost of senior debt, and that means that this company is in trouble, because cost of capital is a way to measure risk and whether a company is in trouble or not. So why is it in trouble? Maybe its earnings are a hint. September 2019, trailing 12 months, that's the most recent statements I could get, 63 million in revenue, and their EBITDA was negative $156 million on 63 million in revenue. And what was the biggest expense driving all this? In the 9 months out of that 12, there was $101 million of compensation expense. $101 million in 9 months compensation expense. There's probably a bunch of options and some weird fair value accounting under IFRS that drives that, but still, $101 million of compensation expense on $63 million in revenue. Conclusion, there's no money in cannabis right now. It's hard to get access to funds. I shouldn't say there's some money, but it's not cheap. It's expensive. This company proves it. Based on this fishy release, I dug into it more. The structuring of this deal just speaks to the trouble. I predict this company is going to have further difficulty, although its management is sophisticated. Would I invest? Not a chance. I'd stay away from this with a 10-foot pool. And not only is it a troubled company, but I think with this sort of deal, they're showing that minority shareholders are just going to get squeezed in this nonstop. That's my view of Acreage. All right, let's wrap this thing up. We've been 45 minutes. So, turnarounds. Remember, you want to evaluate whether a company is going to turn around, evaluate whether they have a turnaround leader. Do not rely on existing management. Existing management is good for when things are stable. You need to change. You need a different person. You need a turnaround leader, someone who can take the company through transition. How do you know if you have a turnaround leader? You look at the resume, you listen to them talk, but the other things you can do is come back to the points that I've brought out in prior shows, and maybe I should do a show summarizing these in the future. but how do you turn around a troubled company? And the first thing you do is you admit you're in trouble. You hit it on the head, like CannTrust did in their release last week. You say, here's all the trouble we have. And if you don't see them doing that, if you see them making excuses, coming up with weird capital structures and issuing press releases, for financing and issuing press releases, that says everything's awesome with this deal, that's not a turnaround leader. To get yourself out of trouble, you need to first admit you're in trouble. You need to change the people around you. You need a turnaround CEO or CRO. You need to get rid of the guys that cause the trouble. You look back to CannTrust. CannTrust did half of that. They brought in a new CEO who in fact was their CFO. So maybe he's new, maybe he's not, I don't really know. But they haven't done the full gambit because the board of directors is more or less the same. And you need to fix it now. You can't have a plan to have a plan. You need to develop a plan like right now, tonight, release it as a general direction and start doing it. And if it's not working tomorrow, change it. And I did it for you live on CannTrust. That would be my plan. And if I were running that place, I'd be up at 6 a.m., 5 a.m. tomorrow morning, and I'd be working on that plan. And maybe it's changed by noon, but it would be the plan. I wouldn't have a committee sitting around trying to figure this out for 6 months, because that is death. Stakeholders needed to be persuaded that there's action, that this is being taken seriously. Sorry, I'm fighting a cold tonight. All right. Thank you very much for listening. I hope you enjoyed this and our review of cannabis last week and troubled companies. This is the Martinis with Scott show. We're a show about winning at business, intending to help management, CEOs, CFOs, the C-suite, directors, investors, shareholders, everybody related to business, stakeholders in businesses, and winning at business. Upcoming conversations, I think we're going to do some shows next week. I'm back in the East finally, and we've got a bunch of interviews lined up, so we'll have some more discussion style shows, which ought to be fun. Please remember to subscribe. Martinis with Scott channel is on YouTube and Apple Podcasts and Spotify. Listen to some back content. Hit subscribe. Thanks very much for listening. It's been a blast. Talk to you in the next day or two.